All right, let's get right into it. Welcome to this explainer on the new IFRS 18 standard. Today, we're taking this massive new presentation and disclosure standard and turning it into a real, actionable playbook for you. If you're out there drafting, auditing, or analyzing financial statements, the ground is shifting under your feet. We are officially leaving behind those flexible, open-ended income statements and stepping into a world of strict categorization and mandatory transparency. So get ready because we're going to break down exactly what you need to know to apply this perfectly in practice. Here is our roadmap for today. We're covering scope and objectives, general presentation, the new P&L categories, aggregation rules, performance measures, and finally, disclosures and exceptions. Keep this checklist handy so you don't miss a thing. Let's kick things off with Section 1, Scope and General Objectives. Notice those exact words on screen: useful, structured, summary. This is literally the beating heart of IFRS 18. The whole point here isn't just ticking compliance boxes. It's about making sure your financials actually give a summary that faithfully represents your performance. Users need to be able to compare you to competitors, compare your current year to past years, and instantly spot where they need to dig into the notes. Everything we're talking about today flows right from this one overarching goal. So, who actually has to do this? Well, the scope is pretty absolute. If you are preparing general-purpose financial statements under IFRS, then this standard governs your presentation. There's no dodging it. The only exception? Except when specific IFRS transition requirements dictate a different treatment during your adoption phase. Moving right along to Section 2, General Presentation Requirements. Here we have a clear policy choice for your statement of financial performance. You've got two options. Option A is a single, continuous statement where the profit or loss section comes first, immediately followed by OCI. Option B lets you use two separate statements, a P&L, immediately followed by a comprehensive income statement. But here's the catch. Whichever policy choice you go with, the sequencing is locked in. Profit or loss must always precede comprehensive income. No mixing and matching. Now, let's talk about prior period adjustments under IAS 8. If you have a retrospective change in accounting policy or an error correction, then you have to adjust the opening balance. But where exactly does that go? It flows straight into the opening balance of retained earnings in the statement of changes in equity. The only time you do otherwise is if a specific IFRS standard explicitly tells you to hit another component of equity. All right, Section 3, P&L classification categories. In the past, we all know companies had a lot of wiggle room in structuring their income statements. Well, not anymore. IFRS 18 brings rigid classification categories. Every single item of income and expense now has to be funneled into one of 5 distinct buckets: operating, investing, financing, income taxes, or discontinued operations. That old unclassified bucket, completely gone. You've got to apply strict conditional logic here to get this right. For instance, if an item relates to receivables for your main goods and services, then you classify it as operating, and it goes directly to the P&L operating category. But if you have financial assets generating an independent return, say a standalone investment portfolio, then it bypasses the operating section entirely and lands in the investing category. You always have to look at the economic substance. Next up is Section 4, Aggregation and Disaggregation. The whole aggregation process really comes down to one key test. Do the underlying economic characteristics share similarities, or are they dissimilar? If they share traits, like HR, IT, and legal costs all being consumed for administration, you combine them into a single line item, like administrative expenses. But if they're dissimilar, like selling expenses versus administrative expenses, you have to separate them to maintain that useful, structured summary. To make this foolproof, just follow this 4-step workflow. 1. Classify items based on what they share. 2. Break them apart based on dissimilar characteristics. 3. Present the resulting line items on your primary statements. And 4. Take whatever material info is left over, the nitty-gritty details that would just clutter up the main page, and disclose it clearly in your notes. But you absolutely must watch out for these strict prohibitions. You shall not obscure useful information by lumping dissimilar things together. And honestly, this is a huge shift for lots of teams. You shall not use the label other if a more precise label actually exists. Unless an aggregated other amount is genuinely immaterial, you have to break it down in the notes so investors aren't left guessing what's hiding in there. Let's turn to Section 5, Management-Defined Performance Measures. So what exactly is a management-defined performance measure, or MDPM? Think of things like adjusted EBITDA. It's a subtotal used in public communications outside the financial statements to show management's view, and it isn't specifically required by IFRS. But now IFRS 18 is pulling these measures directly into the audited financials, which means they require rigorous transparency. If you choose to include an MDPM, you've got to execute these 4 steps flawlessly. First, flag it clearly as an MDPM. Second, explain exactly how the math works. Third, and this is a big one, you must provide a step-by-step mathematical reconciliation from your custom measure back to the most directly comparable IFRS subtotal. And fourth, detail the income tax effect and non-controlling interest impact for every item in that reconciliation. Also, you can't just casually change these metrics year to year to make the numbers look better. If an entity changes, adds, or drops an MDPM, then they have to restate the comparative info for the prior period in the notes. Now, this often introduces significant estimation uncertainty. If restating is truly impracticable, you must explicitly disclose that fact and explain why. Almost there. Section 6, Disclosures, Judgments, and Exceptions. These are the hard lines drawn by the standard. Except when IFRS 8 segment reporting rules apply, your MDPMs must be kept totally distinct from segment reporting. Next, you shall not use deceptive labeling. If a subtotal includes investing returns, you cannot label it profit before financing, because that implies a pure operating number. And finally, unless a line item actually contributes to a useful structured summary, it doesn't need to be presented separately, even if it's listed as a minimum requirement elsewhere. Usefulness trumps the checklist. This brings us to a massive point. IFRS 18 is definitely not an automated checklist you can just hand off. It requires high-level professional judgment. You have to step back and ask, does this aggregate number create a useful structured summary? Is it material? The standard gives you the framework, but you have to make the call. Before we wrap up, make sure you avoid these common application errors. First mistake, omitting the basis of preparation in the notes. The fix? Always include it. Second mistake, burying dissimilar expenses in a single function line. Instead, disclose their qualitative nature. And the third big one, failing to reconcile MDPMs exactly to the nearest IFRS subtotal. Don't stop at a halfway point. Follow that step-by-step reconciliation right back to the IFRS baseline. And there we have it. We've officially completed the topic guide checklist. Scope, general presentation, P&L categories, aggregation, performance measures, and disclosures. I want to leave you with one critical question to take back to your teams today. Does your current chart of accounts naturally flow into these strict new IFRS 18 categories? Or are you looking at a major systemic overhaul? Because under this new standard, how you present your numbers is just as crucial as the numbers themselves. Thanks for hanging out with me for this explainer, and I'll catch you next time.